mode. Awesome. So, hello there, everyone. Thank you for joining us today. Our presentation today is called Home Sweet Home Financial and Practical Insights in Home Buying. I'm the facilitator, Brian Perez, education program developer for Family Housing Resources, and we'll shortly introduce our presenters here today. Before getting started, I do want to start off with talking a little bit about Family Housing Resources. We are a nonprofit organization that has been in the community since 1991. We are a HUD certified housing council agency working with homeownership since 1997. We provide both pre and post purchase housing counseling, home buyer education, financial counseling, and we work in affordable housing by providing housing now through rental properties, housing development, and helping prepare people for housing stability and generational wealth through financial education, home ownership, counseling, and rental counseling. With that, well, let's move forward to what the agenda for today will be. Um, We'll start off with types of government loans, followed by upfront expenses to expect, then the impact of credit on your loans, working with the realtor and fair housing, what makes up mortgage payment, what to expect in the closing and signing process, and how FHR can help. With that, I'm going to go ahead and turn it to our presenters for them to introduce themselves, starting off with Nicholas.
Thanks, Brian. Yeah, I'm Nicolas Pereira, Nick Pereira. I am a program counselor at Family Housing Resources, and I am one of the HUD certified housing counselors here as well.
Hello, everybody. My name is Brian Jackson. I'm the housing navigator here at Family Housing Resources. I'm also a HUD certified counselor. Let's go ahead and jump into the presentation. So, HUD housing counseling. HUD housing counseling addresses the client's unique financial situation and circumstances and focuses on ways of overcoming specific obstacles to achieve a client's housing goal. Some may say, why would I need to do a counseling session with somebody? I already know my budget. I already know my goals. What can I gain? Well, housing counseling consists of independent expert advice customized to your needs of the client and includes intake, financial, and housing affordability analysis. And we will create an action plan to make sure that you move forward on the right step to becoming a homeowner. Now we're going to go over some types of government loans. So we're going to go ahead and start off with one of the most common. That's an FHA, which stands for Federal Housing Administration. A lot of people know about FHA loans due to their low down payment that's needed in minimum requirements when it comes to credit score to get into that type of loan. So as you can see, down payments typically range from anywhere between 3 to 10% for that loan. Minimum credit score of 580, although it is better to have a slightly better score just because they pull multiple times throughout the process. And the Lighthouse program will cover your down payment with the 4%. It does require mortgage insurance, and you will have an upfront cost of 1.75% included in that. It does require it requires mortgage insurance for the life of the loan unless refinanced after the 5 years with Lighthouse. And there's debt to income ratios that they look at. FHA is a little bit more lenient with their requirements. So 43% without including your debt, 50% including your debt. All right, let's take it next. That's going to be a VA loan. Not everyone is going to qualify for one of these, but if you do, congratulations. For VA loans, there is no down payment required. Eligible veterans, active duty service members, and some military spouses will be able to qualify for the VA loans. There is no private mortgage insurance that would be required. It does require there is a required VA funding fee that can be rolled into the loan. So still nothing that you would have to pay up front. Uh, the home must meet VA property standards. So it will get checked in order to qualify. The property itself has to qualify in order for that loan to go through. Lenders set the requirements, usually a minimum of 620, but it can go as low as 500. VA loans are also very reasonable with their debt to income ratio, but additional around 43%. VA does not require a down payment. So the 4% that you get from Lighthouse will go towards the closing costs or the principal.
And then it is important to note another type of government loan is a USDA loan. But for the purposes of our presentation, we will not be talking about it today. But if anyone has any questions or comments, don't hesitate to reach out with your questions.
Now, what's covered under the Lighthouse? Well, you're going to get 4% down payment with Lighthouse and a 6% APR for 30 years on a fixed mortgage rate. The requirement is pending the program you are utilizing. You are able to refinance after 5 years with the down payment support forgiven. If you try to refinance before that, you would need to pay that 4% back. You cannot transfer your reservation to another purchase contract. So once you reserve the funds, it is set to that purchase contract. Now we're going to take a look at some of the upfront expenses and what to expect. Some of the upfront expenses or costs that you're going to see are the appraisal fee, the home inspection fee, and the earnest money deposit. Appraisal fees are $400 to $600 required by the lenders to determine the home's value. Normally, this is paid by the lender and charged back to the buyer at closing. So it will typically be included in your total closing costs. The home inspection is different than an appraisal. You'll want to get a home inspection. It is very important to make sure that nothing is failing in the home that you're purchasing and that there's no structural issues with the home. So in Tucson, the average for a home inspection is now anywhere between $350 to $550, and it does vary by location and home size. Your earnest money deposit is typically 1% of the home price, paid when your offer is accepted, and it's applied towards your closing costs or down payment at the time of closing. Now we're going to move on and talk about some property taxes and homeowners insurance. These can be some prepaid costs. Depending on the loan product, lenders often require up to 6 months of property taxes and 1 year of homeowners insurance to be paid upfront into the escrow account. So that means if I'm closing on April 9th of 2025, if you're paying for the prorated to the end of this month, May, and then your first payment is June 1st. Depending on your lender requirements, that can change, but ultimately you're going to be paying that portion up front to make sure that they know when you close, you're good until the next payment. Now, mortgage insurance, if applicable, is also going to be prorated up front. And the HOA fee, it's a standard fee, and dues are needing to be paid in advance. It also depends on the HOA.
And then it is important to note that it's up to 6 months and 1 year doesn't mean it is 6 months and 1 year. So it could be that it's 1 month, 1 month. So it's just important to get that across, just because when people see those numbers are like 6 months and a year, doesn't mean it's applicable, but talk with your lender if you want to make sure.
Now we're going to talk about your cash responsibility at closing. Now, typically, you should anticipate anywhere between 2 to 5% of the purchase price. This can sometimes be negotiated for the seller assistance. This does include lender fees, title insurance, escrow fees, prepaid taxes, and insurance, etc. So all of these fees, the insurance, the title, everything is included in that upfront cost that you're responsible for bringing at closing. And the Lighthouse program can pay for some, if not all of those costs. Starting, so title and title insurance starts at 0.5% of the home costs and ensures the property has a clear title with no legal claims, and recording and transfer fees and taxes. You want to make sure that it goes through smoothly, which is why these are required. You don't want to try to buy something that someone has a lien on that may not be reported, which is why that title search and insurance is very, very important. The seller or lender credits can help offset these costs as well when applicable.
All right, thank you very much for leading us to that portion of the presentation, Brian. So I'm going to go ahead and take over briefly for our next few slides, and then we'll go ahead and turn it over to Nicholas. So the impact of credit on your loan. It is noteworthy to mention that if you're participating in the Lighthouse program, everyone will be getting that 6% APR interest rate. So it may not be that if you have a 750 or a 640 that you'll see different rates in your interest rate. For the Lighthouse program, everyone is getting the same interest rate as long as they meet the minimum qualifications. But because credit does play a big role in moving forward with your finances and increasing and improving your financial health, we do think it would be important to talk about here today, particularly when it comes to getting a new auto. Normally, because what we see is either the car comes first and then the home, or the home and then the car. So it's a valuable point to touch on to kind of give perspective as to the power that having a good credit score has when it comes to obtaining an auto and the amount of money you save in the long run. So we look at this example. We're moving forward with an individual getting a $40,000 auto loan for 5 years on a new car. And we see how their credit score impacts their interest rates. So if we look here, someone with a 500 credit score would get an interest rate of about 17%, where their monthly payment is about $1,000, and they pay an interest 19,730. So effectively, they are paying for a $40,000 vehicle about $60,000 over the life of the loan, compared to someone with a 720 credit score or higher, where you'd be paying a 6.8% interest rate with a monthly payment of about $800 and paying an interest about $7,300. So we see that effectively they're paying about $47,000 for the car compared to the individual with the 500 credit score paying about $60,000. So it really emphasizes the benefit of having a great credit score when getting an item financed. So what builds a healthy credit score? This is a great item to touch on, as we hear quite a bit, is like how to improve my credit, or how can I rebuild my credit. It is important to note, depending on the lending institution you're looking at, it could be a FICO 8 score or a Vantage 3.0 score. They do weigh out their categories differently. If you're interested to learn more, feel free to contact us, and I'll be more than happy to lead you through those differences. But the main thing that impacts your FICO 8 score is payment history, where 35% of your payment history is allocated to calculating your score. So it's a biggie. Make sure you make your payments on time. Even one missed payment or one late payment could have a significant impact on your credit, where you can see a decrease depending on your credit score by anywhere from 20 to 100 points, depending on how big that missed payment was and how often it's occurring. The other one is the amount owed. This kind of goes into both lowering your debt and also keeping your credit utilization low. Normally, the rule of thumb is to keep your credit utilization under 30%, but there is a spectrum. It could be that if you have a utilization up to 90, get it to 50, then to 30, and then the golden standard is 10% or under. That's when you'll see a significant improvement in your credit score if you are above that 50% utilization. Don't open too much credit. We see that that's part of that new credit and length of credit history. So let's say if you were to apply for 3 credit cards today, that would look a little bit suspicious. It gives kind of like a red flag that, oh, maybe this individual doesn't have the income to sustain their spending habits. So don't apply for too many credit cards at the same time, and make sure that if you do, don't close out an old credit card because you got some new ones. The longer you've had a credit card open, the more it's contributing to your credit score. In other words, a credit card that you've had for 7 years has a better picture of how you are as a consumer compared to a credit card that you've had for 3 months. So make sure to not close old credit cards. And if you do apply for new ones, apply for a minimal amount at a time, maybe one a year or two a year. And then have a mix of credit that contributes 10% to your FICO 8 score. What that means is secured loans versus unsecured loans. They don't want to see that you only have credit cards and personal loans, stuff that doesn't have collateral. They also want to see how it is that you manage your finances when now you have asked for a loan, and now you have something to put up for collateral, such as a mortgage is actually a great example, because if you were to not make your payments, you do put yourself at risk of losing your home. So the for you showing that when you have something to lose and you'll keep up with your payments does speak to the type of consumer that you are. So having a mix of unsecured loans and unsecured loans does help in improving your credit as well. And with that, the final slide for me here is review your credit report yearly to limit reporting mistakes. This is a big thing that's been becoming more and more prevalent, which is fraud. And a lot of times people are actually not aware that they are victims of fraud. And one of the best ways to determine if you are a victim of fraud is to check your credit report. You could pull it for free through annualcreditreport.com to see if you are a victim of fraud. That's when you pull it, that's when you know that, oh, I was never in Florida, I never bought a jet ski in Florida, I never bought a condo in Idaho, I've never left Tucson, whatever it may be. So that's a great place to check. And I always reiterate that fraud has become more prevalent. We hear it all the time of data breaches, information being leaked, and so on. So make sure to check your credit report at least once a year. And the most important thing to check into is for account information. If something doesn't look correct to you, make sure to submit a dispute. And if you need any assistance with that or want to make sure that you're understanding your credit report correctly, don't hesitate to reach out. You'll see our information at the end of the presentation, and we'll be more than happy to help you going through that. So with that, I'm going to go ahead and turn it over to Nicholas.
Thanks, Brian. So here's working with a realtor for housing topics, among other topics as well. Here, home inspection. Home inspection is not necessarily required for all transactions, but is highly recommended. And if you are available, it is a great idea to attend in person as well with your home inspector. Even if you don't have the experience, it's a great learning experience in general, and also help you identify crucial aspects of your potential home, assuming you eventually buy that home, such as identifying where the home shut-offs are, all types of important aspects. Bonus points too, as it says there, bring a trusted person with you to the inspection. If you know somebody that has experience in construction or home repair, that'd be great too. Either way, it's nice to have another set of eyes on the home. A note on home inspectors. Home inspectors are human, and different home inspectors can have different opinions regarding the status of an appliance or an area of the home. So I think either way, it's a great idea to attend if you can, and see for yourself to learn and be more informed on this potential future property of yours.
And here for this one, the benefit of knowing your shutoffs is if, let's say, a pipe breaks in your home and you don't know where the water shutoff is, it's going to flood your entire home. Or maybe for some reason a circuit rips somewhere in your home, and now to prevent a fire, you need to know how to turn off the electricity. So it's super important, and we'll also be talking about that in our next presentation on May 7th, planning for the unexpected and insurance.
Correct. What's to expect from your realtor, right? With any relationship, responsiveness and communication is a big one. Properties to consider and view based on your needs and wants for this this big purchase. You should build rapport with your realtor so you each understand what your goals are. And then therefore properties to consider and view based on your needs and wants. You can certainly verbalize your needs and wants, or it can be a good idea to write down the parameters of what you and your household need in a property. And that, of course, can range from size, number of bathrooms, backyard space, or location specifications. You expect your realtor to have your best interest in mind. And that will be easier, of course, through communicating what you really need or what you want. Another expectations from your realtor to be negotiate on your behalf, of course, with either the seller or the seller's agent. Stay on top of paperwork, and eventually close and negotiate on your behalf. Local realtors have maybe like a Rolodex of recommendations for home inspectors, movers, or handyman if you don't have one that you want to hire. So that's why having a good in the know realtor is beneficial as well. A good realtor should have a good idea of the local market as well and any comparable sales to the type of property you're looking for, or any current trends that might help you, the buyer, and help the realtor find the right property. Also, with down payment assistance programs and Lighthouse or other local programs, they often have rules or timelines to follow if you are using a certain assistance program. So you need to make sure you are following each program's rules or timelines. Down payment assistance programs have maximum turnaround times often for entering a purchase agreement if you are approved. For example, after being approved for assistance, you may need to enter a purchase agreement within 60, 45, or even 30 days. So it's good to make sure that you and your realtor are aware of any deadlines to make the purchase contract, and that all work out. Let's see. Federal fair housing, federal fair housing laws in there to protect against discrimination in the housing market, such as steering towards different areas of town, if you're a certain group, or even being rejected based on your national origin, or either of these 7 protected characteristics: race, color, national origin, religion, sex, disability, or familial status. A lot of the work that housing counseling agencies do are the fair housing complaints. We help facilitate those. So if you are unfortunately encounter any type of discrimination, please let us know. We can help eradicate those types of practices within our community. Mortgage. What makes up your mortgage payments? The principal, interest, taxes, and insurance, and sometimes association dues. So monthly payments, PITI, mortgage insurance, escrow accounts. So the escrow account, so you go into escrow when you enter a purchase agreement, and then like that 30-day window typically is considered escrow. But there's also the escrow account where it's a third party where your taxes and insurance go. so that typically the title company has access to pay your taxes and insurance throughout the year, to pay the taxes and insurance, as opposed to a lump sum, like at the end of the year, kind of like how your income taxes would go. Yeah, paying taxes throughout the year instead of a large lump sum at the end of the year. So they are collecting an estimated amount into escrow each month of taxes and insurance to prevent that lump sum. Then, oh, it comes time to pay your taxes and insurance, and say, for example, you don't have that, that's not really acceptable. So they're already taking out this money each month, um, to make these taxes and insurance payments. We often say the taxes and insurance portion of your mortgage or PITA may fluctuate throughout the life of the loan, but by fluctuate, it's typically increase from year to year. So monthly payments. So mortgage monthly payment, at closing, while you're signing all your paperwork, there will be specific instructions on where and how to pay your mortgage. And then depending on your mortgage servicer, you can typically pay your mortgage in different ways. These days, online options are the most popular. But if for some reason that doesn't work for you, depending on the servicer, of course, they may offer other over the phone or mail-in options. Also, it's common that there's a high probability or possibility that your mortgage servicer may change during the life of the loan, and that just means you'll be paying to a new servicer who is now handling your loan. They can switch hands throughout the 30-year loan term, definitely. But if that happens, you will be notified by mail weeks in advance for the new address or new place to pay your mortgage. And here's a little example on how PITI factors into your mortgage payment: principal, interest, taxes, and insurance. So these are all things to consider, of course, when you make your budgeting for your new home and your mortgage and your household expenses and income. So here it says, if you leave out taxes and insurance when estimating how much home you qualify, hold on, I lost, how much loan you qualify for. And here the chart, you can see it stays the same, the first few lines, but then on the right hand side, that takes into consideration the principal, interest, taxes, and insurance. You can really afford much less home once you take into account these additional costs. Without taking into consideration, looks like you can afford a $470,800 home, but after including taxes and insurance that are due each month, these are required. Realistically, 375,000 is your budget. Kind of like with any type of, so for example, a car loan, like Brian brought up earlier, you're budgeting for the interest and the payment on the car, but then you can't forget about the insurance, and that's a monthly cost as well. And with insurance rates rising, people often lump it together, like my car costs this much, which is the car payment and the insurance. But necessarily with these calculations, you're not necessarily counting your insurance at first, but on the back end, you have to take into account taxes and insurance that will be inevitable throughout the loan. Yeah, it's over $100,000. It's a lot of money. Insurance. Let's see here. So this is just in general insurance. There's private mortgage insurance, there's mortgage protection insurance. There's all types of different types of insurance when you own a home. We're highlighting PMI and MPI because they're very similar. Well, the letters are switched around. But they're different different types of insurance. Mortgage protection insurance, MPI, will cover your mortgage payments if you lose your job or become disabled, or will pay off the mortgage when you die. So that's kind of like similar to like a life insurance, but for homeowners, if for some type of emergency were to happen. And then on the flip, PMI, private mortgage insurance, is more for your lender. It is for your lender, because it'll reimburse your mortgage lender if you default on your loan, and then your house wasn't worth enough to repay the debt in full through a foreclosure sale. So yeah, it had nothing to do with MPI. Those are completely different things. And again, with the lighthouse, only way to remove this would be to refinance after 5 years. And we're highlighting PMI and MPI again because they sound very similar, but they're different. So it's kind of an overarching theme that there's going to be all kinds of different insurance coverages out there to kind of know what you're getting into and know what's covered. If MPI is right for your household, in case, this sounds like it'd be good for you. And that's an add-on. But private mortgage insurance, is different, and then it depends on your loan to value ratio. I think we'll get into that, I think, in the next slide. And here again is highlighting MPI versus PMI. Private mortgage insurance protects the lender required for mortgages with a down payment under 20%. And you can ask for the PMI to be removed once you hit 20% or 80%, excuse me. And the mortgage lender arranges the policy. Premiums are typically paid upfront, but they can be, premiums are typically paid with your monthly mortgage payments, but they can be paid upfront. And then, yeah, we went over MPI already. Let's see. Homeowners insurance and home warranty. You will need homeowners insurance and may want to consider home warranty for regular wear and tear. Yeah, there's all types of insurances out there. Standard insurance. Standard homeowners insurance will typically cover repairs to your home, maybe a fire, lightning, or hail damage. However, most typical insurances will not cover things such as floods or earthquakes or damage due to the floods and earthquakes. So depending on where you live and what makes sense, it may be in your best interest to look into these other types of coverages. And then we were having another presentation on planning for the unexpected, disaster planning and insurance, coming soon if you want to learn more. Excuse me. What to expect in the closing and signing process. So at closing is like a happy but can be a stressful time because there's a lot going on and you're almost there, but the property isn't exactly yours yet, and there's still a lot of paperwork and review to be done. So at closing, who is there? Your closing agent, well, buyer's agent could potentially be there. And what to bring. An ID for every person listed on the mortgage, and a binder for homeowners insurance and paid receipts. Receipts is a big one. Depending on the terms of your loan, all the numbers have to match from the previous closing disclosure. So you should know exactly how much you paid, and especially with these assistance programs, you're usually required to put down a certain amount. So just it's a really good idea to keep your receipts, and that's pretty much true for any transaction. But yeah, just be prepared to sign and have your paperwork ready. And if you need to call somebody to ensure what you need to have beforehand, that can be a good idea too.
And it is important to note that if you're working this day, either see if you could get the day off or set some hours aside to make sure you know where you are going, who are you meeting with, and what is expected for you to bring as well. So just make sure to give yourself some time to be able to get there prepared.
Yeah, take the day off if you can, if you're gonna show up in person, because you don't want any delays. So for more on closing, right, I mentioned the closing disclosure prior. So you be able to 3 days prior, you should review the closing disclosure, make sure everything's up to par, the numbers match. Um, there'll be like a cash to close, so you know exactly how much you need at the end. And that's where you would, instead of paying that in cash, a cashier's check is best. So you can get a receipt, like we had mentioned. Um, you can, like we mentioned, going in person. You can do a lot of it online these days as well. And like it says here, signing electronically cuts down on your time, right? Like we mentioned, taking the day off or having to drive across town. But some people like to show up in person, and kind of just have a handle on things, um, on the paperwork. Because yeah, if you go in person, you must coordinate with an agent and title and other representatives, time and place. Um, you will sign the promissory note, deed of trust. These are um, binding legal documents. The promissory note outlines the terms of the loan agreement, and it is signed by the buyer, borrower, and promises that you, the buyer, the borrower, will pay the agreed upon amounts, the promise to pay within the laid amount of time. These are, for just repayment terms that you're signing and agreeing to. And then the deed of trust is another legal document outlining that the property, uh, should you not be able to pay, will be used as collateral if you default on your loan. And it would also transfers title to you or the new trustee, as well as other disclosures. So post signing, after signing, there's still, yeah, you signed, what you needed to sign is still the property, the home isn't yours just yet. Um, the loan provider and title company need to review, make sure everything's in order. The seller has to, the liens, make sure there's nothing um, that the seller had to do and they fell short. That well, we're in Pima County, so the Pima County recorder needs to record the transaction, um, for it to be official, signed, notarized, stamped. This all takes time, so you need to want to make sure everything's ready, and that's why it shows here examples of why you may face delays before signing or after. The appraisal falls short of the agreed upon amount, or the home inspection shows significant issues that weren't corrected, or issues in the title search or contingency agreements.
And it is noteworthy to mention that if the home inspection does show items that need to be resolved and they're not be resolved by the move-in date due to whatever reason, you may not be allowed to move in until those are resolved. So it's important to keep that in mind. We hope you don't come across that, but it's better to be safe than sorry.
So pitfalls that could stop you from receiving your loan. Um, and so highlighting being responsive to your lender, not providing documents on time, could slow down or stop you from receiving the loan entirely. There are a lot of moving parts, the lender, the realtor, assistance programs, and then you need to sign something, they need to sign something. So there's a lot of moving parts, and if one person's not doing their part, and then the other person can't sign it till the next day, working hours, it can really cause delay, especially towards the end of a purchase agreement. So being responsive is a really really big one, especially with time ledger deadlines or locking in any rates or assistance. Changing your financial circumstances close to the close of escrow, right? Because that could affect your credit score, and then now you don't get quite the rate. Now the numbers don't work, and that's could delay things or kill the deal entirely. So it's best to not buy any big ticket items on credit or using a significant amount of reserves. And that includes refinancing prior loans, existing loans, and avoid applying for new credit even or loans. It might be tempting to start purchasing for your new home, furniture, appliances, what have you, but you need to wait until the contract is finalized. Because last minute credit checks do happen, the lender will do a soft pull before closing to make sure everything's up to par. And if that soft pull shows you applying for new loans or new credit and your credit score is taking a hit, that could affect your purchase agreement. Yeah, changing of your credit score if you're already between credit ranges, yeah, can definitely affect closing. And then what happens if your credit score drops? Rescore is possible, but the ultimate pitfall will be no longer qualifying for the original loan and losing the purchase contract.
So with that, I want to thank both Nicholas and Brian for leading us through our presentation. With this, and I want to do a quick overview of how we here at Family Housing Resources can help you in not only your home ownership journey, but your financial journey as well. Once you move into your property and you find yourselves maybe wanting to develop a maintenance plan or a budget to keep up with your household expenses, we're more than happy to offer post-purchase counseling with one of us as a HUD certified housing counselor. As you've already taken, you've seen our home buyer education, but you're also able to meet with us if you have any questions, comments, or want to expand on a topic as well. And then if any of you have find yourselves maybe at that 640 credit score and really want to get the best deals when trying to finance a new car, finance new appliances, furniture, whatever it may be, we do offer credit counseling with certified credit counselors to help bring your score to the highest possible amount that it can to get those very competitive rates. I will mention, since credit scores can go up to 850, that is a bit more of a long run. Um, but if even getting up to 750 is very manageable and possible within about, depending on your circumstances, within a reasonable amount of time. Down payment assistance programs. If you may know of anyone that's interested, we do help first time home buyers in obtaining that down payment assistance to be able to move into their home. And then financial education. If now you're trying to understand what type of insurances to get, how your taxes are going to be impacted, or how to even expand your investment portfolio besides just your home. We do offer education to help individuals learn about that and build a solid foundation, which they can then expand on with certified financial planners or financial advisors with for more personal and professional guidance. And finally, some financial coaching. This one really comes into being able to help people stay accountable on their goals and reaching those goals as well. Sometimes we don't have that buddy to check in on us. We forget about our goals and time passes and we don't move forward. We're here to help you move towards your financial goals and get to that financial freedom that you're trying to reach. And for more information, if you want to contact us, you could reach out at info@fhrinc.net, where you could ask for either one of us, Brian with the Y, Brian for an I, or Nicholas. We're here to help and we're more than happy to. And you can also give us a call at 520-318-0993. And with that, we want to thank you. We want to thank everyone for being here today, for watching our webinar today. We greatly appreciate it. And as mentioned, with any questions or comments, don't hesitate to reach out. We're here to help you in moving forward with your goals and aspirations. So thank you, and we look forward to seeing you in the next one. Bye.
Thanks.